So welcome back from lunch. It's my pleasure to introduce the academic keynote. It's going to be moderated by Sophie L'Helias. Sophie L'Helias is a board member of ECGI. She's been a champion of sustainability for many years. You've got her CV. The thing that you don't have in her CV, which is a slightly kept secret, is that she was actually instrumental in setting up Climate Action 100 plus. So she's actually made a material positive contribution to the topics we are discussing today. Now, the academic keynote is going to be given by Oliver Hart. Oliver is a professor of economics at Harvard University. He is also the Nobel Prize recipient in economics was in 2016, and he is also an ECGI Fellow. And with this, I turn it over to you, Sophie, and to you, Oliver. And I think, thank you.
Thank you very much. I hope everybody can hear me. Thank you, Marco, for putting on this conference, and to Herman. And it's a great event. It's a privilege to be here and to listen to everybody. And, you know, I'm going to talk about some of the things I'm going to talk about have already been mentioned by others, but I will repeat them in some cases. So, yes, this is joint work with Luigi Zingales. So the first slide, I mean, I think it's, you know, it doesn't really need to be said to this audience that there's been a dramatic increase in shareholder engagement on environmental and social issues in the last few years, and Commissioner Crenshaw already referred to that. Here's a figure which also sort of shows you that this has happened. So in this diagram you have on the vertical axis the average support for ESG proposals, and we've divided them up into the environmental ones, that's the blue graph, the social ones red, and the political ones green. And you can see there's an upward trend in all of them, except you see a downward movement on the environmental ones just very recently. I think that's because institutions like BlackRock have got a bit scared about their support for these things, so they've backed off. But in general, it's clear the trend is upwards with you know, considerable support up to 40%, or I think actually we heard more than that from Commissioner Crenshaw in some cases. So why is this happening? It's not easy to explain this behavior using the dominant corporate governance paradigm in economics. That paradigm says that companies should be maximizing shareholder value, the profit basically, because that's what shareholders want. Shareholders will all want that. They'll all want to be as wealthy as possible. And even if that's true, even if they're socially responsible people, they can always use you know, the extra wealth being delivered to them to do good on their own account through charitable contributions and the like. So that's the sort of established wisdom. But when you look at these proposals and the fact that they're getting significant support, in some cases majority support, I mean, the thing that's puzzling is these proposals are, in many cases, pushing companies to do things that might reduce shareholder value, most of which are opposed by management. So what's going on? Well, we think the following things are going on. Corporations are larger, more complex, more powerful than they were in the 70s and 80s when the paradigm became established. The world has more people in it, it's more interdependent, externalities have become more important, and there's this feeling, a widespread feeling, that governments are not dealing with them. Another factor is some people argue that the preferences of investors have changed, that younger people, millennials and onwards, they're more sensitive to environmental and social issues. I do recall, though, as a member of the 60s generation, people thought that the 60s people were going to be entirely different, but look what happened. So I'm not banking on this. But anyway, for all these reasons, perhaps things are changing, and we think that the paradigm has to shift too. This is true even if one accepts, as we do, the idea of shareholder primacy. We accept that because most companies are set up with votes allocated to shareholders. They don't have to be set up that way. You can choose to set up a company and give workers the votes or consumers the votes or whatever, but most of the major companies are ones where the shareholders have the votes, and that seems to suggest that they're meant to be run on behalf of shareholders. However, so we stick with that, but we argue that in a world where externalities are important, some investors are socially responsible. And here, when I talk about investors, I'm going to right back down the chain to I'm not talking about the intermediaries like BlackRock and Vanguard. I'm talking about the people behind the intermediaries, which are people like you and me. And I think many of us are at least somewhat socially responsible. And so given all that, and given that governments aren't solving problems, we think that shareholders will sometimes be willing to accept getting a lower dividend in return for the company they own to behave in a socially responsible manner. And that's why we think companies should take that into account, and they should therefore be maximizing shareholder welfare, which takes into account these social preferences, not shareholder value. So we talk about SWM, not SVM. Now, I think it's useful to have some examples to sort of illustrate what we're talking about. So here are some, a couple of which are based on actual shareholder resolutions. So DuPont generates large quantities of plastic waste. Reducing the waste would improve the environment, but reduce profit. It would be costly to avoid that waste. If you think about shareholders, how might they feel about this? Well, some of them might be willing to accept a lower dividend in return for less waste. Why? There's several reasons. First of all, they might also own other companies that are impacted by DuPont's plastic waste, and that maybe the profits of these other companies go down, so they have some sort of diversified portfolio. So, that's one possible reason. A second reason is they might be affected directly by the plastic waste. Maybe it impacts the environment they're in. The third reason is they may be somewhat altruistic, so the plastic waste is actually hurting other people than themselves, but they care somewhat about that. For all those reasons, those shareholders might say to DuPont, please reduce the plastic waste. On the other hand, other shareholders might, of course, they may be only invested in DuPont, they may be not socially responsible at all, and the waste isn't affecting them, so they would say, we want more profit. So you get a disagreement there. And by the way, it could be that people with large shareholdings in DuPont, those may be the people who are going to be less socially responsible. They might be voting for, if there was a vote, to continue the waste, because for them, the reduced dividend is going to hit harder because they have a large shareholding. This might speak a little to one of the things that Colin Mayer was saying when he talked about families actually being, acting worse. It could be because they have a large shareholding, although I think he also mentioned that when management has a significant shareholding, things somehow go better. So that doesn't quite fit with the story, but I think that deserves further investigation. Second example, Costco uses antibiotics in raising chickens. This is profit maximizing, but is a major cause of the development of antibiotic resistance, a problem that costs human lives and billions of dollars in health care costs. And again, so the ditto there just says, the same sort of argument, discussion can be had that some of the shareholders of Costco may think this is a bad thing and would like Costco to stop doing it, but other shareholders may like the higher profit. Okay, next, Danco is the US distributor of the abortifacient drug Mifeprex, so this is an abortion pill. Danco is a private company, so this is somewhat hypothetical what I'm saying here. One could imagine, though, it's a private company, it could have different shareholders. Some of them might be anti-abortion, and so they might want Danco to scale back on these activities, even though Danco is, I believe, making a profit from them. Other shareholders may feel exactly the opposite. They may want abortion to be more easily available, and they might want Danco to expand beyond the profit-maximizing point. Okay, so again, disagreement is possible. Duke Energy makes contributions to political candidates and parties. Disclosing these, reducing them, could be bad for profit, but good for American democracy. Again, different shareholders may have different views about that. Okay, it's worth asking at this point how all of this fits in with Friedman's famous argument that we've already heard about today several times, where he argued, well, shareholders will want companies to maximize profit and then do the any social responsibility stuff themselves on their own private accounts. He had in mind, I think, charitable contributions, that kind of philanthropy, where companies do not have a comparative advantage in doing that, and it makes perfect sense to delegate that to shareholders. They can do it privately. But the examples I've given just now don't fit into that category, because these are all things where the company actually has a comparative advantage in reducing harm. So I don't know whether I can go back. Perhaps I can't. But you remember, plastic waste, okay? It's not the case that DuPont creates the plastic waste and then individual shareholders can go and remove it. I mean, they could try to do it, but apart from the coordination problem, there's also the fact that the cost of getting rid of the plastic may far exceed the lost profit from avoiding it in the first place. It's just a very inefficient thing to do, and that's true of all the examples I've given. So charity, Friedman's argument applies to charity because charitable activity is separable from the company's ordinary business activities. But there are lots of examples in pollution, carbon footprints, where what the company's, the social stuff, the social impact stuff is inextricably connected to the company's business. So in those cases then, the Friedman argument breaks down. Shareholder value maximization will not be unanimously favored. It's also the case, this is a little more subtle, it's not even socially efficient among the group of shareholders. So there's no particular reason to think that the profit that the shareholders get from the plastic, from dumping it, exceeds the disutility that the socially responsible shareholders feel about that plastic waste. And if you had a sort of what economists would call a Coasian bargain, if they all got together and could exchange money, it could well be the case that the people who don't like the plastic waste could bribe the other people to agree to eliminate it. So SVM, shareholder value maximization, is not unanimously favored, and there's no reason to think it's efficient among the group of shareholders as a whole, let alone for society. Friedman, in his New York Times article, suggested, and others have also said this, that deviations from shareholder value maximization impose a tax on some shareholders, the ones who are not socially responsible, and then, if they're in the minority, then the other ones, the socially responsible people, are taxing them when there's a deviation from SVM. Yes, but it's symmetric. It's also the case that if SVM is pursued, then the socially responsible people are being taxed by the others, the ones who like profit. So there's nothing, there's total symmetry there. Okay, so for these reasons, Luigi and I have been advocating that SVM should be replaced with SWM, shareholder welfare maximization. How to do it, we talk a bit in the paper. It's not easy to do it in an ideal way, but one way which it may not be ideal, but it's not bad, is to have more shareholder voting. So let's have shareholders vote on company policy. So in each of the examples I gave, but I won't go through them all, let's go back to DuPont and the plastic waste. You could imagine an up or down vote by shareholders on whether the waste should be reduced. But this is not so easy to do today because most stocks, and again I'm saying something that other people have said, most stocks in the USA are owned through mutual funds, intermediaries like Vanguard, BlackRock, State Street, etc. These institutions do the voting for the retail investors, you and me, and often we don't even know how they're voting. There was a little discussion about how this information could be made available more quickly to us, but most people, really aren't following what's going on. Furthermore, most institutions take the view that their fiduciary duty to us requires them to only focus on long-run financial returns. So in deciding on how to vote, they should be looking at the long-run financial return of the outcome of the vote and nothing else. And in some cases in the US, this is a legal requirement when it comes to pension money. But even outside pension money, it's sort of an article of faith of most institutions that's what they should do and really have to do. To give an example, so this is a recent example which illustrates how this happens in practice and how they're, I think what's happening can be criticized, that I don't think it's good, the status quo. But let's look at this example. So Alstria, a German-listed real estate investment trust, proposed a so-called green dividend to shareholders at its May 2021 shareholder meeting. The proposal offered a 0.01 euro per share dividend, so you can get a dividend, but then they asked shareholders whether the dividend should be paid out or be invested in pre-identified climate mitigation projects. Now, Alstria already pursues climate mitigation efforts as part of its normal business activities, such as purchasing 100% of its energy from renewable sources and undertaking an extensive carbon reduction plan. But what set these additional projects apart is that they would not have made compelling investments for the company from a purely financial perspective. So that's what the company said. It was completely upfront about this. So the board said if shareholders supported the project investments, the board would treat this as a clear mandate to invest outside the financial norms. Okay, enter Dimensional Fund Advisors, which is a global asset manager that is a shareholder of Alstria. So now some people will be familiar with Dimensional Fund Advisors. They are a very large asset manager. They have, I think, $600 or $700 billion under management. And they're known to economists because they were inspired, their setting up was inspired by the work of Eugene Farmer, who's a Nobel Laureate in economics. And he didn't set the company up himself, but I think one of his students did. And he is still involved quite a bit, has always been involved in it and advises them, along with Ken French, who is his collaborator. So that's just a little bit of background information. Now, Dimensional engaged with Alstria's CEO to discuss this green dividend proposal. Dimensional emphasized that their view was that the duty of the board, that is Alstria's board, was to maximize shareholder value. They sort of appreciated the fact that the company was upfront about the fact that this would not maximize shareholder value. But then Dimensional said, well, our own stewardship efforts are focused on protecting and enhancing shareholder value of, our investors. So, we think you have an obligation to your investors, we also have an obligation to our investors. And, we agree this is not a good project from a profit point of view. So we feel obliged to vote against the proposal, which they did. In spite of this, the proposal passed with 85% support. So it went ahead. Now, I think what's interesting about this is my view. So here was Dimensional saying, taking a narrow view of fiduciary duty. I actually was at a talk given by a Dimensional engagement person who she was talking about this, and I asked her, well, did you think of asking your own investors how they felt about this? And she said no. So I think that makes no sense. And just more generally, the situation where people are interpreting, asset managers are interpreting their fiduciary duty to mean maximizing financial return. It seems to me they should be finding out from their investors whether those investors are willing to make trade-offs instead of just taking this very narrow point of view. I think Luigi and I think the situation should change. And how could it change? Well, here are three possibilities. The first is you could push down the voting decision to the level of the individual investors. So this is a strategy that BlackRock is trying to implement now with its major investors, and it might extend it to retail investors. So in the case of Dimensional, that would mean they would say to their own investors who might be, well, I don't think it's me, I'm not invested in them, but it's somebody you might be, and they might ask you, how would you like to vote? You could vote whatever your pro rata share of the shares we have in Alstria, we're going to let you vote those. And then we'll aggregate it all up and tell them what the overall vote is. So that's a possibility. And we give the example of New York State Common Retirement Fund and so on. But it's the same idea, so I won't go through that. So this strategy of pushing the voting down to the retail investor level is possible, but the trouble is it's going to impose a large burden on retail investors, right? Retail investors are individuals, they have day jobs, they don't really want to spend all their time thinking about shareholder resolutions. Well, there is a possible way out of this, which is that today, many institutional investors buy proxy advising services customized to specific needs. For example, ISS, Institutional Shareholder Services, has 6 sets of specialty proxy voting guidelines, each geared towards a specific special interest group. So they have one for labor, socially responsible investment. They have faith-based ones. So if you're a Catholic, they say, when it comes to social issues, this may be the way you're going to vote on things. And you could then select that, and then somebody else would do the voting for you based on this guideline. And then there are ones on sustainability and climate. So this would be a way of taking the pressure off the retail investor. They would have to think in advance about, what kind of guideline they like. So there would be some ex-ante thinking. But then once they've check the box and say, I like this one, then they wouldn't have to think anymore. Somebody else would be doing the voting for them. So that's one possibility. A second possibility is for mutual funds, the intermediaries, to elicit investors' preferences and then cast votes at the intermediary level based on an aggregation of these preferences. So, for example, you could ask the retail investors, suppose there's a proposal which would lead to a reduction in carbon emissions of 1 ton, but it's going to cost you $100. Would you be willing to support that? Is that the kind of trade-off you're willing to make? And some people would say yes. And then, you could say, well, what about if it costs $200? And, fewer people would say yes, and so on. And you could calibrate this and get some idea of the trade-offs and then, aggregate them up. Of course, one question here is, economists are very familiar with this issue about truthful reporting. Are people going to tell the truth about their valuations in a setting like that. And you know, you have to worry about incentive compatibility, and it can get quite complicated, and we haven't solved that problem. But at least in principle, that's possible. In fact, there are some attempts to do this. There are some companies that are trying to collect that kind of information from, like Betterment, from retail investors, and then communicate it to intermediaries like Fidelity. The third strategy is for intermediaries to offer funds with a very clear predetermined voting strategy. So this is, in other words, you could have a fund which is, let's say, we're a S&P 500 fund. We're not going to actively trade. It's going to be passive. It's an index fund. But we're going to engage. And we're going to engage in the following ways. We're going to be pushing companies to reduce their carbon footprint. Maybe they could be more specific and say, again, we'll do it whenever you can reduce a ton of carbon emissions at a price of less than or equal to $100. They could be specific about that. They might say, we're also going to be pushing for more diversity in the workplace, more diverse boards, and all of that. And they could lay that out. And then, if you like that idea, you can put your money with them instead of some other fund. It's still an index fund, but it's with an engagement agenda. You know, somebody else can set up a fund. In fact, this is happening, which is what I would call a Milton Friedman fund. We're going to be pushing companies, again, we're an index fund, we're going to be pushing companies to maximize profit and do nothing else. Sole objective, and you know, if you like that idea, you can put your money with them, and we'll see what happens. You know, the market will decide who wins. This is actually happening to some extent. Engine number one, which had this famous victory in getting 3 people on the ExxonMobil board, then set up a fund called Vote, which has that kind of, which has a sort of engagement agenda. I'll come back to that if I remember in a minute. I'm actually, yes, I'm now going, this is pretty much what I want to say. Let me just summarize and conclude with a few other observations. So the bottom line is SVM, although it's the established criterion, does not, I think in today's world, probably never did, but it's clearer now than ever. It does not represent generally what shareholders want, and we think it should be replaced by SWM, and we think one way to do this is to make it easier for shareholders to express their preferences on environmental and social issues, e.g. by voting, but then there are other ways I've discussed. In terms of policy, so it was very interesting to hear Commissioner Crenshaw talk about what the SEC is doing. I think, you know, one of the things they do still today is they can determine whether a shareholder resolution gets voted on at all. I mean, if a company doesn't like a shareholder resolution and wants to block it, the SEC can either allow them to block it or not allow them to block it. Now, historically, the SEC has often made it quite easy to block because they've taken the view that resolutions which are about the ordinary business of the company should not be voted on. So if you took that literally, that would be like saying that when it comes to plastic waste, well, this is an ordinary business matter, whether the company should be making more money by having more plastic waste. Or to take an example from not so long ago, there was a shareholder resolution about whether Walmart should stop selling high-powered guns in its stores, which it was doing particularly in the South, I think. And the SEC allowed that to be blocked because it was about an ordinary business matter, whether you should what you should sell in your stores. Well, Commissioner Crenshaw has indicated at dinner last night that she doesn't think that's the way things are done now, and which is good to hear. But because I think, you know, if you accept the argument I'm making, all the examples are about ordinary business matters. They're about externalities that are caused in the normal, you know, doing normal business, making money. we have in another paper we talk about DuPont. Again, DuPont, back in 1984, had a choice about whether to dump some toxic waste in the Ohio River or incinerate it, and it decided to dump the waste, and that caused a lot of illness and death later on. Well, that isn't, I think that's not an ordinary business. I mean, it's an ordinary business matter, but it's something that shareholders can have a view on and should have a view on and should be allowed to express that view. So I think that perhaps the right way to think of it is that proposals that pertain to a company's comparative advantage should be allowed. So in all the examples I gave, these were things which the company could avoid. The company could avoid it, and it was in a unique position to do it. And that seems to me, those are things where shareholder voice should be allowed to be heard. As opposed to, I'll give you an example, suppose there was a resolution saying that the company should give 50% of its profits to Oxfam. And I think one could say that's really got nothing to do with the business of the company, whatever it is, Amazon or something. And it would be reasonable. I don't think that would get majority support from shareholders anyway, but I would be quite happy if that proposal was not permitted to go forward. But that's separable from the business, whereas the other ones are not. They have to do with, just to repeat, something where the company has a comparative advantage in either avoiding harm or doing good. Okay, next, the meaning of fiduciary duty, I think, needs to be reconsidered. And again, this was also discussed earlier. This may require changes in the law, even outside pension money. So let's go back to the example of Dimensional. Suppose Dimensional had canvassed its shareholders and found that a majority of them wanted to vote for this proposal, for the green dividend to be used, not to be paid out, to be used for green projects. Suppose that was the case. Could the minority who disliked this, who didn't like this, could they have sued Dimensional on the grounds that Dimensional was breaching its fiduciary duty to its investors, interpreted narrowly to mean maximize financial return? I don't know the answer to that. I'd be interested in anyone who thinks they have the answer. If you're a company in Delaware and the majority wants to give up some money to avoid harm, and the company respects the wishes of the majority, can the minority sue? I don't think we know. At least I don't know. You may know. So with that sort of ambiguity, I think the law has to be changed so that fiduciary duty, it means finding out the trade-offs of your investors, and then if the majority wants to do something, then the minority just has to go along with it. I think that's the right way to think about it. Okay, the other thing is trade-offs should be acknowledged. So this is something Patrick Bolton also mentioned, that when you talk to practitioners in this area, they're always talking about win-win. When they say, oh yeah, we love ESG, it's great. But then when you push them on, well, are you willing to do something which is, good from an ESG point of view, but reduces long-run financial return, that doesn't compute for them. They always say, oh, no. If you really look at the long run, if it's long enough, it's going to be good for the company because it'll be good for their reputation. Consumers will like it. Workers will like it. They always say that. And just as an example, going back to engine number 1, so at the very same meeting I was at where the person from Dimensional was talking, and I asked her that question about whether she consulted investors. There was also someone from engine number 1, and with their vote fund, they have an engagement strategy. When I pushed him on it, he said, yes, we're engaging companies. We want them to be greener, but that's because we think that's going to be good for long-run shareholder value. And I said, what happens if it's not good for long-run shareholder value? Well, then he was basically saying, we don't do it. We're not willing to go that far. But why did he do that? I think it's because perhaps he's scared that if he said that they were willing to do that, he could be liable to lawsuits. So again, I think to get all this stuff going, we have to not only change people's attitudes, but we also, in some cases, have to change the law. Okay, let me stop there. Thank you.
Is it working? Yes. Thank you. Thank you, Professor Hart, for a very engaging presentation. I want to say what an honor it is for me to be here and to engage you on this topic in particular that holds dear at heart. I read your paper and listened, and we discussed last night and again today with multiple hats, both from an investor perspective, that I used to run an investment fund, from a board perspective, public companies, or an investor board company. And I found that your paper touched all these aspects, and that's why I thought it was extremely relevant. I thought perhaps we could just start with one question and then throw it to the audience. We also have a very good question online, so please send your questions over there. One area that I thought would be interesting that was talked about this morning, particularly from the SEC commissioner, is the difference between the United States, Europe, and Asia and other markets. Europe, Asia, and other markets may be more advanced on some of these issues than the United States, both for historic reasons, maybe legal reasons, and philosophical reasons. And as I read your paper, one of the questions I asked myself was whether you had extracted the resolutions that came from US investors versus non-US investors, and whether you had considered perhaps extending your study to other markets. And there's a reason behind that. If we look at the 20th century on governance in particular, governance followed capital flows, and they came from the US to Europe particularly, but not just in Europe. The last 20 years, we've seen a reversal of that. And what we've seen is capital flows coming to the US from foreign markets, but also governance practices and other practices. And just to name regulatory practices as well, just to name a few, Say on Pay, which is a big governance, but also the TCFD. We're seeing increasing number of investors asking US companies to comply with TCFD. Data privacy, which is GDPR in Europe, but certain practices and expectations on that. So I'd just like to get your thought on that in terms of the what I call the maturity level of the companies, but also of the investors in this topic.
Yeah, thanks, Sophie. That's a good set of questions. Sorry. Thanks, Sophie. That's a good set of questions. This paper undoubtedly is quite US-centric, and that's probably because we are in the US, even though both of us are European. So my sense is that in Europe, it's a bit easier to navigate these legal issues. There isn't so much of a focus on fiduciary duty, just meaning financial return. But I think we need to spend a bit more time thinking about that. So I think that's the sort of questions you're asking, I think, are topics for future research. In terms of but I mean, obviously the same issues arise everywhere. The same idea about trade-offs, that's going to be important everywhere. Just how you implement what can be done under the existing legal framework and where the law has to change, that may be somewhat different in different jurisdictions. In terms of who's behind these resolutions, it's a good question. We should look into that. But I think in some cases, you know, it's things like, I think Marco mentioned as you sow. I don't think of that as a European thing, or is it? No, it's American. So my guess would be a lot of them are coming from Americans, but to be checked.
And I just wanted to go to the question here, which I think is a very interesting one. So what should be the objective of management when applying shareholder wealth management? More specifically, how should management deal with trade-offs between various social interests?
Well, you know, our view is they need to find out what their investors, their shareholders want, as opposed to making these social trade-offs themselves. I mean, that's one one part of the Friedman article I agree with. I mean, he started off by talking about management making social decisions on behalf of the company, and he was against that, and I agree with him on that. But then he went on to say, and, you know, shareholders shouldn't be doing it either, and that's where I disagree with him. So I think, it's what's wrong at the moment, I think, is managers are doing this according to their own judgments and views. And that's also true, you know, with the intermediaries. Like Larry Fink decides whether some environmental proposal is good or bad. He's not consulting his own investors about it, but he should be.
So one of the things that was raised again by the commissioner earlier was the notion of materiality, and Europe has a very different view of materiality. It has a double materiality, which actually is what I find really raised in your article, and double materiality being the impact of the externality on the company and its financial impact. It could be not just financial, but financial impact in particular, but also the company's impact on society. And that's really the trend in Europe. The US is much more on the financial materiality. One of the questions, and I see this practically, and I just was curious in terms of your research, is in terms of the trade-offs and the materiality, it's also part of strategy. How would, in your research, how would companies best integrate that? What are the best processes or procedures to integrate some of these externalities and align that with their strategy?
Well, not quite sure how to answer that. I mean, I think if reducing harm, let's DuPont. If reducing the harm from the plastic waste, is somewhat costly and is going to hurt short-run profit, but is going to make DuPont look very good to the world, and there's going to be some nice publicity about it, and more consumers are going to buy DuPont products, and workers are going to want to work for DuPont and so on, then, that's sort of easy. That's the low-hanging fruit. That's win-win stuff. It's good for the world, and it's also good for the bottom line. And so, I don't think you have to consult anybody very much about that. But then, when you go beyond that to the point where further reductions in waste are actually going to hurt the bottom line, that's where, I'm going to repeat what I said, that's where you have to, I think you should be finding out whether shareholders are willing to make that trade-off.
And would an investment philosophy, for example, a clear investment philosophy, be a way for consultation for you, or would you, in your model, do you anticipate a much more direct interaction?
You mean an investment philosophy of the company? Of
the company, or just here's our policy and how we invest on these topics as a mutual fund owner, right? Would you,
as a mutual fund owner, that's like engine number one with its sort of platform, political, engagement platform. That's fine.
So you'd see that growing.
I think if a company did it, it would be fine if they did it when they started out, in the IPO. And then, you can invest in that company if you like that or not. But I don't think, they can do it midstream. Then they should be consulting the shareholders.
I found your Alstria example very, very interesting and very compelling. What we're seeing also in other companies in Europe is companies that go to shareholders for the transformation into a purpose company. And they actually bring that to the board. The board reviews it, they talk to their stakeholders, and then they bring it to the investors. And that creates constraints, trade-offs that you talk about, with clear commitments, some targets, some objectives that investors vote on. That's something that we're beginning to see in Europe in some companies, but it clearly evokes what you're talking about. I'd like to bring perhaps to the floor because, here we are. We have another one. Activist shareholders, formerly known as corporate raiders, mostly engaged to improve business financial performance, not ESG factors. How would you counteract that? Well,
to the extent that whatever activist shareholders are proposing has to get majority support from existing shareholders, via a vote, which is often the case in the US these days, given the availability of poison pills and the like. The days of the hostile takeover are pretty much over. So at the end of the day, if some activist comes along and says, we want you to stop all this, to focus more on profit, on the bottom line, if the shareholders approve that, okay, so be it. And if they disapprove it, so be it. The activist, or to take another example, I think about Musk's bid for Twitter. This is something that eventually got a shareholder vote. I am a shareholder of Twitter. I have 0.00, whatever it is, through some mutual fund. And I decided, it's one which allows me to do the voting. I was trying to decide how to vote. Initially, I decided I would vote against it because I didn't like the idea of Musk controlling Twitter, which is something I don't use at all, but I'm aware of some of the social implications of it. But then, because he wanted to back out of the deal, I thought that was really bad, so I voted for it. So, that's just an example where you could imagine, if I go with my first intended vote, that would have been a case where I would be giving up a premium, right? But of course, as a negligible shareholder, we're talking about, maybe $100 a premium. I would be saying I'm willing to give that up in return for him not controlling Twitter. So that's the way, an offer from some outsider who wants to just maximize profit could actually be rebuffed through a vote. So, that seems to be what... Now, in fact, it turns out that management often seems to bow to the wishes of activists without ever, it coming to a vote, which I think is an interesting thing. Why do they do that? I'm not sure they have to do it. That's what people said about, the board of Twitter could have just refused Musk's bid in the first place. If they could have done that.
They could have.
Yeah.
But that's another research piece on the impact of activists on boards and board behavior.
Yeah.
So there's one question that I can't fully read, so I apologize from Paul Herrenberg. It's on the bottom. There you go. So what is your take on a top-down instead of a shareholder proposal approach? The board putting to a vote concrete projects entailing irreversible externalities.
Yeah, well, to the extent that we're talking about the board actually requesting shareholder input, I think that's a great idea. I'd like to see much more of that. Instead of thinking of the shareholders as a nuisance and all shareholder proposals as something, bad news, we don't like them. Instead, they could see shareholder engagement as a positive thing. And that's what I think they should be doing. They should be saying to themselves, how can we best act in the interest of the shareholders? Well, we need to find out what they want.
And in practice, is there a question over there? There we go.
Hi, my name's Deborah Gilshin. I run my own advisory business in investment stewardship. And just picking up on the point you've just made, a lot of the presentations today and the comments have been on shareholder proposals. But one thing we don't talk about is that they're often seen as quite combative when actually they're an exercise of a key shareholder right. And I think a lot of shareholders are often reticent to use them because they may be seen as too combative. And it goes to a wider point about stewardship more generally. Guy Jubb made a point earlier about attending annual general meetings and making statements, which again is a key shareholder right. But we don't see a lot of investors doing that. We see some, but not all. And I guess my premise is that if really regardless of what type of capitalism you believe in, shareholder welfare capitalism, stakeholder capitalism, shareholder primacy, we need investment stewardship to be using all of the tools that we have as equity shareholders to meet its full potential. And I wonder, why you think it is that we just see certain tools used and not others when it comes to shareholder rights.
Gosh, and the trouble is my hearing is sufficiently bad. I'm not sure I caught a lot of that. Did you?
I caught because it's not that loud, so apologies. But your comment was about investors committing to shareholder proposals, the name and shaming that they worry about, and they don't get engaged on in terms of the shareholder proposal itself, and they don't use that tool sufficiently, in your view. And it's really about that. It's more about the fear factor, if I may say, about shareholder proposals and voting on some of these ESG topics. That was her perception in her practice.
Are we talking about intermediaries here? Or
I won't. It's just, I guess, why you don't see shareholder proposals filed by a lot of mainstream asset managers.
Oh, right, okay. Okay,
yeah.
so that's an interesting question, why that's happening. What seems to be happening, from what I read, is that it's often gadflies who put up these proposals, but then they get support from the institutions. So it's not that they are necessarily afraid of supporting them, although now they may be, because, of course, they're getting pushback, particularly from Republicans in the US, who are saying, you know, BlackRock is too woke. Now, if BlackRock was consulting its retail investors about what proposals it should support, then it would avoid that criticism, because I don't think, I hesitate, even Republicans would find it difficult to criticize individuals for supporting things. So, but it is an interesting question why they're, but it may be related to this, that they don't want, you know, they're going to get attacked if they actually initiate these things. But again, if they were doing it on behalf of their own investors, then I think they would avoid that criticism.
Yes. Lady in the front, sorry.
Okay,
Can you
thank
speak loudly so I can hear?
Thank you. I'm Lisbeth Ridder, Secretary General of the Belgian Governance Institute, Geberne. Thank you very much for your very interesting presentation, and I might trickle my observations down to a more micro level, a bit less macro. But I think indeed that, and I'm talking about family business. I also lead our Family Business Governance Center. I think it's really important that shareholders accept that the ESG transition comes at a cost. That it comes at a cost. There's no secret about that. I also think, I believe we need some real role models from within the system. We already saw Patagonia, of course, which are radical solutions. Maybe not everybody has to be as radical. At a more local level, we had CPEF, which is a listed Belgian company, where the next generation, upfront of the renewation of the shareholder agreement, put some requirements about ESG. They said if there are not some ESG conditions respected, we will not, as a next gen, renew or update our shareholder agreement. So I think this was really important. But what I think is really important from a shareholder perspective is that where the shareholders have to give just like they have to give a kind of idea of the risk appetite they want to have as a shareholder, be it a very low risk appetite to a rather broad risk appetite, they also have to define a certain sustainability risk appetite. How do we want to position ourselves, and how far do we want to go? And I think this is important for the board and for the CEO, for the mandate they have. So I think really shareholders have to consider this amongst themselves. Where do we want to position ourselves? How far do we want to go? And what mandate do we give to our board? And the board can give to our CEO accordingly. We have all known the experience of Danone, where things have gone wrong in that respect. So I think this is important. And in the same dimension, I think it's really important that there also in the war of talent, this is an issue. People do identify with some purposes or goals. If you want to attract some top talents, they want to identify with what the company stands for more than ever. But that we also have to educate board members and shareholders on ESG, what it's all about, what the consequences of some things are, and what the potential is. And I also believe, where you said there are short-term opportunities, but there is also the long-term reward. And I think, I truly believe personally, I'm not speaking for Goberna here, the organization I represent, that we need some change makers from within the system. We can't expect that it comes from without the system. I truly believe that we need some people who from in the system change things. Thank you.
Well, I don't think I disagree with anything you said. I mean, yeah, but I mean, you also mentioned that I think trade-offs again, that people can't have to be educated out of the view or be persuaded to admit that yeah, you know, being environmentally good or being good in all other ways, it's not always going to be good for the bottom line. The value of a company does not represent its total contribution to society. You know, economic theory tells us that there are some conditions under which that statement is true, that the value of a company, the net present value of its profits does represent its contributions. Those conditions are extremely restrictive: perfect competition, complete markets, no externalities, or externalities perfectly controlled by governments around the world. I mean, stuff which, yeah, it's a wonderful benchmark, but it's not reality. So as soon as you recognize that, you realize that we're in a world of trade-offs. But everything else you say, I also agreed with.
Any other questions? Yes, there's a lady up there. Thank you. And we also have a question here, which I want to make sure that we address.
Can you speak as loudly as you can?
I will try. Is this loud enough?
So far,
No.
yes.
Okay. I have a question on fiduciary duty. You were just discussing that the traditional definition of a fiduciary duty doesn't take into consideration ESG into investment decision. But I am wondering, given the definition of how we understand ESG risk today and what we were speaking before, the cost that it would that companies would have to cover if they don't act on time, shouldn't we consider that ESG risk should be integrated now in this new vision of fiduciary duty? Because if we ignore this ESG risk, we are not taking investment decisions focused on promoting the long-term financial performance of companies.
Well, what I'm really saying is that if I'm a fiduciary and, you know, everyone in this room is an investor in my mutual fund, it's reasonable that I have a duty of loyalty to all of you because I'm acting on your behalf. But to me, what that means is I should find out what you want. So if some of you are willing to give up some money to reduce the carbon footprint of a company that I'm invested in on your behalf, if some of you are willing to do that and others are not, but let's say most of you want to do it, then acting loyally means taking that into account. And I should not then, you know, if I voted not to reduce the carbon footprint because that was going to reduce profit, if I did that and I said I'm doing that because my duty of loyalty to you means I've got to maximize financial return, that seems to me to be being disloyal to you, because I'm not taking into account the fact that most of you don't like this additional carbon footprint, and you actually don't want to make more money that way. So all I'm saying is, I think that, you know, duty of loyalty makes a lot of sense, but it means, you know, no one would say, or at least I don't think many people, if I was acting on behalf of a single person, if I was a trustee for a single person, and we do have things like that, trust, and I was looking after your money and I simply maximized return without, and you were passionate about the environment, and you didn't want me to do that, it seemed to me that it would be disloyal for me to do it. I should be trying to act according to your interests. And I don't think that's any different if there are a large number of people I'm representing rather than just one. So that's really all I'm saying. Fiduciary duty needs to simply be reinterpreted to mean doing what my trustees, is that what they're called? What they want. Beneficiaries.
Unfortunately, I think we could last for another hour, just if not two, to listen to you, Professor. But I just want to conclude, because this is in this international forum that we're building, that what you've raised is that there needs to be more additional research between what's going on perhaps in Europe and other markets, as well as the US, and that I think will lead us forward. And with that, I would like to thank you very, very much for making the time to be with us today. Thank you, Professor.